What I will say to introduce this is that over the past 6 months, we've seen an enormous number of challenges across a whole range of different types of arenas of activity. As teachers, we've obviously seen lots of challenges trying to teach into this space. Pension fund trustees, who are the subject of my research, are clearly in that space as well. They have had to deal not just with the challenges that arise in investment markets, but challenges to their the operation of their funds, changes to the terms under which they interact with their members, for instance, with the government recently making adjustments to the early release scheme in Australia. And so what my paper is about is trying to track some of that and to understand how that might work in the context of hang on a second. This is a bit odd. Something strange has happened here. Right, okay. I'm terribly sorry, but I'm seeing one thing on the screen and you're seeing something quite different. So the challenges that I wish to have a look at are climate change, the coronavirus, and I've thrown in Bitcoin in there as well. Why those three? Well, the three different challenges, and in Australia we've had two aspects of climate change. We've had the drought and we've had bushfires. The challenges that are created are quite different for the decision-making processes that superannuation fund trustees have had to go through. And so they provide a really useful prism through which to investigate this notion of investment prudence. The question that the paper asks are traditional notions of prudence sufficient? And those of you who have a background in trust law or in equity generally will know that the way in which the courts have dealt with the trustee decisions in relation to investment has evolved. So if you go back to the 19th century, the late Industrial Revolution, as courts were entering that period, they were requiring trustees to behave in a very conservative manner, investing only in government-backed fixed income securities. But that gradually through the second half of that century and the first half of the 20th century, the courts started to relax the range of investments that were permitted. And in fact, much of that was prompted also by Parliament in a series of acts, series of statutes, extending the list of authorised investments that were permitted for trustees. What you see, though, as that progresses is a progression from what we might think of as looking at authorised investments to viewing the investment decisions of trustees through a different prism, principally the prism of the duty of care. In that prism, you are looking for evidence that the trustee has considered carefully the investment options that are out there. Now, some of those were still deemed to be too speculative, and by the end of the 19th century, some of the famous cases that are listed in the detailed paper are still talking about commercial activities as being too risky for trustee investment. However, what happens is that you also see, as the 20th century develops, more endemic inflation, and this is true also in the late part of the 19th century, a demand for capital from developing banks, railways, a variety of trading companies, and others. And so over the course of that century, from about 1850 through to about 1950, you see us move from a very, very conservative position where trustees were entitled only to invest in a limited number of securities unless there was specific provision made in the trust instrument, to a situation where by 1950, that process had, by and large, been completely overtaken. And we see that modern portfolio theory comes along about 20 or 30 years later, saying that, when we're thinking about risk, yes, individual securities might have a particular level of risk, but when you view them in a portfolio, that might change your view, that they might diversify the portfolio in some way, and so their contribution to total portfolio risk might be less than you might have seen. From a legal perspective, this represents a move from those legal lists I talked about to a series of duties that work collaboratively, to some extent, to look to regulate the investment by trustees. Duty of care, the duty to exercise your powers in the best interests of members, which orientates you towards the purpose for which the treaty is doing, and more precisely, the proper purposes doctrine, which very much focuses on your use of the power to invest for proper purposes and not for some ulterior motive. If you distill all of that down to practicality, what's going on, what you find is that the law, as it stands, really looks to three different types of risk management processes. Careful research, which reduces uncertainty about information to the extent that that can be reduced. It's probably a limit, but certainly it can. But that's expensive. It costs money, costs time to go and do that research. And so there is a bit of a cost-benefit analysis that needs to go on there. You also have diversification, which has for a long time been one of the cornerstones of trustee investment, but also investment theory, and in fact tracks back a lot further than the modern portfolio theory, mathematization of investments in the 1950s, but now has a much more formal, we have a much more formal understanding of what that might mean. And I include in there strategic asset allocation, which I think of as being, it's a term that's used in the industry to talk about the allocation to different types of investments, but it's very much driven by what you might think of as smart diversification. So taking those types of risks that you want to take, which you think will be compensated in the market. So investing in the share market is a way to hopefully harness the capitalism and the way that corporate profits work. The third type of risk that is very much a part of the trustee's toolkit is insurance. So taking insurance out for a specific event or on a specific security or asset, and whether that's a general insurance contract or an option over a particular security, that has a slightly different way of dealing with risk. So those are the traditional techniques that you would associate with prudence. The bottom line of the paper is that the governance that's not going to actually be enough in the when you're faced with either a COVID type threat or a climate change type threat. And as a result, trustees of super funds, and I extend this in the paper to trustees of pension funds in the United Kingdom, will need to address their governance structures and processes to ensure that they can take decisive and timely action in respect of these extreme risks that we've seen recently. So much of the first half of the paper deals with the legal issues behind all of that. And for those of you that are interested, that territory has been mapped by legal historians in the past. I've done a bit of a distillation of that and pulled out the bits that I think are most relevant. But the second half of the paper is really looking at these unusual risks that we've seen. The first of which we talk about is climate change. Now, climate change is interesting from the perspectives that this paper is taking, because in the first place, it appears to be very slow moving. That is, we're dealing with a risk that's playing out over potentially many years, perhaps even many decades. And so there is always in the mind of the decision maker faced with that risk that we might have time to do something that doesn't have to be now. We don't necessarily have to do everything immediately, which is quite unusual in terms of risk. Usually there's an assumption that you need to move quickly. It's also ubiquitous. We can't get out of the way of it. It's likely to affect everything in different ways. And so it's not something that you can completely ignore. But as I said, the question is when might you adapt? The other thing, another important aspect of it is that mitigation may be expensive. Now, there are certain things that you can do already. Certainly, you can be investing in technologies that are likely to thrive as we seek solutions to climate change. And that is certain, and many super funds are doing that. But other types of mitigation are expensive. And what's more, there's a crisis of the commons factor going here, where you will find yourself potentially in a position where if you move and nobody else does, that you bear the costs of it. And so everybody will hang back or will continue to do what they were doing. And the ultimate burden of that will be much greater, but it's difficult to catalyze individual action. And we also know that trustees are required to maintain a focus on their members' best financial interests. And so their members may be close to retirement or may have particular risk exposures, and that can cause problems. And we saw in Cowan and Scargill as how the court had to try to deal with that, with the complexities that come out of that. So it's a very particular type of risk. There are a range of uncertainties. We don't know how quickly things will happen and more particularly when markets will react to that, so that they then become financially consequential for the trust. We also have a degree of political risk in that particular projects might get affected in respect of infrastructure projects or other things that people are investing in. But also there might be things like carbon taxes and other sorts of initiatives that are taken that have a wider scale. The advantage that we have to some extent in all of this, of course, is that these issues are now widely recognized across the markets. And so there's plenty of people looking at research in this area. One of the challenges, though, is that trustees don't necessarily know what others are doing in the space. We'll come back to why that might be an interesting opportunity in a moment. So what can trustees do? Well, as I've said, they can identify potential winners and ensure specific risks. And that's what the traditional approach to trustee investment would suggest that they do. One of the things that trustees tend to forget, though, is that they also sit atop an institution that has probably unparalleled access to information outside the public sphere. So there are very few private organizations or networks of private organizations that can know as much as a pension fund sitting on top of 10 or 20 or 40 billion dollars in Australia can do. They can contact all their investment managers and have an enormous information capture. The challenge then is, what do you do with all that information? How do you bring it together? And so that management information challenge, I think, is a big one. What else could they do? So the reason for raising that is because that suggests that certain types of research may be easier to do than perhaps is widely understood. You can design the product that you're providing to your members and launch tailored ESG options. That won't address the risks that exist across the rest of your portfolio, but it can enable those who are more members who are more concerned about it to take personal action. We do need to revisit the governance protocols, and particularly board protocols. When you have a challenge that plays out over 10 or 20 years but is expensive to deal with today, you have problems of mismatch in terms of the agents, in this case the directors of the trustee, having a different time frame than the institution has. And so a range of ways you might think of how you might reorganize your board protocols in order to ensure that the institutional memory, but also the institutional risk appetite, is more closely aligned with the needs of the members that you have. You can imagine a situation where directors were changing over very quickly, where they would have a very short-term time horizon and might therefore not be inclined to step in and deal with climate risks. Clearly, there's a lot of more that needs to be done in terms of communicating with members, and the current case between the member of REST and the trustee there will be very interesting to see how that plays out. How is it that the trustee is able to demonstrate that it does actually have regard to the risks of climate change? The final one I've got there has a risk of sounding a bit cynical, and I don't mean to be, but one of the issues that trustees face is that the prudence of their acts will be gauged against the standards of the community. By joining various compacts and other sorts of initiatives that enable them to see what others are doing and also to join in that, they, in a sense, get a form of herd immunity, if you'll excuse my use of that expression, in the sense that they will be part of a general push and also encourage others to do what they're doing. And so the risk that they themselves will be seen as somehow eccentric or idiosyncratic is reduced. And so from a very practical perspective, that may actually be a risk management approach for many trustees. And so that sounds like that risk sounding a bit cynical, but that is something that they might consider doing in order to be able to do the things that they think are actually the right things to do. So climate change has a particular set of characteristics. COVID is quite different. We've known for a long time that there was a chance of a viral pandemic of some description. There's plenty of evidence of that, and the paper records all sorts of both research but also steps that governments had taken or thought they'd taken to plan for this situation. So it's a question of when, not if. It's been very fast moving, certainly related in comparison to something like the climate change. And curiously, unlike most risks, it is somewhat predictable in the sense that you can predict to some extent what the course of the viral pandemic will be. What is more difficult to predict has been two other things, which is how markets will react to that, because it does have both financial and real market impacts, and also the political risk element. So there is uncertainty there, but it's a different type of uncertainty. And in particular, what we've seen in the political risk arena is some quite different approaches taken across the world. And in Australia, for instance, you've seen the early release scheme, which is causing all sorts of grief and continues to cause all sorts of grief to trustees trying to adapt to that. What we know is that you actually are required to have a business continuity plan, or what I've called disaster recovery plan, but a business continuity plan. But that really deals with the operational elements, which are not inconsiderable in the case of COVID. Quite clearly, working from home has caused all sorts of problems, not just here, but for trustees whose master custody arrangements operate out of India or Singapore or other places. So you have rules related to lockdowns and so on that aren't necessarily those that are in your jurisdiction, but actually maybe some jurisdiction somewhere else in the world that you have not as much transparency around. You can also ensure that you have liquidity management plans, and we've seen evidence in the marketplace already of some funds coming under pressure on that front. Importantly, what people tend to be underestimating, I think, other than those who are actually in the funds, is the need to have switching procedures. So if you are offering members the ability to move their money about, then those procedures have to be incredibly efficient, robust, and fair. We see reference over the weekend to one fund having changed its valuation of some of its assets in a way that will severely affect potentially the group of members who chose to switch their funds over the last couple of months. That's clearly a governance issue. I've talked already about the information network, your ability as a trustee to harvest and harness all the information that's available. But you also have a need to be able to respond potentially in very short order to these sorts of risks. Unlike climate change, perhaps, there is a much greater need to be able to react quickly. And I would suggest that funds that are reliant on boards to make their decisions are going to struggle to do that, and appropriate delegation processes are therefore critical. When we move to Bitcoin, we get an altogether different type of risk. We can see it's extremely volatile. In fact, Bitcoin halved and then jumped back again just in the course of the couple of months that this paper was being written. We know that in many of the jurisdictions, common law jurisdictions around the world, it's been recognized that cryptocurrencies are an asset capable of being held on trust. I suspect there'll be a lot more litigation and therefore case authority outlining exactly what that means. But the problem here is that, and the reason why I put it in here, is that unlike the previous two risks, this is a risk where there's lack of transparency and thin trading volumes creates a different type of uncertainty, in this case, a type of unpredictability that makes it very difficult for investors to be able to demonstrate due care when they're making their investment decisions. There are, in addition, as we've seen, custody risks around Bitcoins going missing, people losing their PIN numbers and various other things. Also, there's been obviously attacks on various wallet providers and so on. And so the paper goes through some of how that plays out and the way in which that might be difficult for a trustee to manage. And finally, you have the risk of scandal, which is a reputational risk, particularly obvious where you have a lack of transparency and you're not quite sure who the other participants in the market are. You can find yourself in a very uncomfortable company without too much trouble. So the conclusion that Baber comes to is that whilst you needed to engage with the previous two types of risk, this is not a type of a risk that I would suggest a trustee today could prudently take on. In summary then, it seems to me that traditional prudence, as understood in investment trust law or trust law of investments, is outgunned in the face of these extreme risks. You need to have a governance response to certainly the first two, which includes things like ensuring that you have appropriate delegations, that your risk frameworks are not purely based on historical calculations, that they are actually much more holistic than that. Because as we've seen, some of the knowns that we've looked at have been known unknowns, but some have been unknown unknowns, if I can borrow Dr. Rumsfeld's description. We know that there's a very important need to get your management information systems working well so that you get early and accurate indicators of where there might be stresses within an institution. That could be around things like liquidity, but it could be also around things like valuations. And it could be liquidity within a portfolio, or it could be calls on liquidity to meet member redemptions and so on. The other thing we need to do is ensure there's institutional memory, because that's not built into the current governance structure of most boards, other than having the same people sit on boards for many decades, which we know carries with it other problems. Finally, I'll just note two things that would not traditionally be expected as being part of a discussion about prudence, and that is that it's absolutely crucial to pay attention to the way in which you organize your product, the investment menu, the options that you make available, and the switching and unit pricing that might be available. And finally, member communications are absolutely crucial. Making sure that you communicate in an appropriate way is something that has become very apparent as we've gone through this COVID experience, both as university researchers, as members of the community and so on, and also, I think, increasingly as members of superannuation funds. So those governance aspects are also a key part, because if you get those wrong as a superannuation fund trustee, you can find that members behave in ways that are not necessarily conducive in their interests, and certainly not easy to manage as a trustee. That was all I was going to do.